Okay, welcome back everyone. Let's get right into the stock market technical analysis. Sorry about this morning for all the members. My internet was out. I had to have Comcast come fix the thing. So we're back online. I'll get right into what I'm seeing in the charts today. Triple Qs, guys. So on triple Qs, you know, we got the Fed coming up on Wednesday. I don't think it makes sense to have big positions on anything, whether you're long or short, at least the indices. On triple Qs, on the hourly chart, I continue to see this bullish divergence that's right there. You can see it, boom. Bullish divergence, RSI and the PPO, and we're just kind of drifting sideways. So it's right in the middle. We could pop up. We've got some resistance overhead, lots of resistance overhead. I mean, we have this downtrend line here we could watch, which would be running right about 295.50. That's decent resistance. Also, if you look at the daily chart, this support line that I drew, the secondary support line, that would also fall in about 295.50 as resistance. So that's possible. Obviously, if I go back to the hourly chart, if they want to sell this thing down, we could back test this. I've got a little bit of a bullish falling wedge pattern on the hourly chart, and we could run down and back test that, pop down, make a new low. All right. It's all going to take place probably pretty quick and impulsively right after the Fed. So it's going to be pretty choppy. We'll have to just kind of keep an eye on it, but I don't know which way it's going to go at the moment. So what I do when I don't know is I lighten up, and that's what I've pretty much done. I actually just closed out my triple Qs short that I took at the end of the day on Friday. Small profit. Would have been more if I could get to it this morning, but my internet was out. So got to it just now, took it off, got a little profit out of it. And I'm probably going to just sit flat into the Fed on my triple Qs trade, okay? That's what I'm going to do. And just because I see bullish divergence, if anything, I might even want to go long, but I'm not going to do it ahead of the Fed, all right? I'm going to wait till after the Fed, and then we'll see how this thing plays out. Let's look at the SPY, S&P 500. Well, there's your bullish divergence right there on the RSI. Not so much on the PPO. I take that back. You could probably call this bullish divergence. It's not as clean as the RSI, but it's there. You've kind of got an equal low in momentum, but lower price. So these are divergent lows. And again, you know, I just could see a rally here. Now, where do we rally to on the SPY? If I go to the daily chart, the support line we've been walking up since the June lows is right here. So that's support. We're below it now. So we could pop up and tag that as resistance about 390, 375, somewhere right in there. You've also got, that's about it. If we break above that, you've got really decent resistance up here at 410. And then the bear market trend line resistance is right here about 423. You can see it marked here. That's the all-time highs, and this is the trend we've been walking down. So if they can recover this, maybe they could rally it all the way up to here. That is the potential. Again, I don't see any reason to take a position ahead of the Fed, so no position here, obviously. Okay, gold. This is probably my favorite right now for a potential long trade. And I'd almost rather go long this than I would triple Qs. Here's what I like about it. One, we are below this major support of 1680, okay? This area on the daily chart for gold, this is gold bullion, has been support since 2020. You can see all the little ticks and tags of that trend, of that support line have held. Right now, we're just below it, right there, just barely below it. But this breakdown is just obvious bullish divergence on the daily chart, okay? There it is. So I see the potential for a bear trap. Now, again, likely this is going to make a move after the Fed. I suspect we'll probably continue to chop around, maybe make a new low. But I don't suspect we're going to have an impulsive rally ahead of the Fed. But there could be a rally ahead of or after the Fed, because the Fed, it's all about interest rates, and gold is all about the inverse to the dollar, and the dollar trades, relative to interest rates. So again, what I see as the potential, going back to the daily chart, given the bullish divergence, is a snap back above the 1680, signaling a bear trap. And yeah, that's kind of what I'm thinking. So maybe they sell this thing down tomorrow. I don't know. But after the Fed, if we can get back above 1680 and really get a daily close above that level and cleanly above that level, it's going to signal that this price action over the last few days was a bear trap. All right. And then we should have a pretty impulsive rally out of that. So looking for that. Let's look at the dollar futures here. So again, the dollar futures is really the kind of the inverse of the gold chart. You've got a clean uptrend line. We've been walking up that uptrend line, and we have negative divergence on the both RSI and the PPO. So definitely divergent. We continue to make divergent highs. You can see the PPO already had a bearish crossover right there. So this last divergent high, you know, has a high probability of failing. Now, what we need to see for a sell signal is a break of this trend right here. Okay, so I've got it kind of marked out there. I just need to see the trend line break, and then we get that trend line break. That's going to signal a sell signal on the dollar and most likely the buy signal on gold. And that will be very bullish for the miners. So the miners, the gold miners, are a leverage play on gold. So if we get bullish signals in gold and sell signals, bearish sell signals in the dollar, the miners should rally a lot more to the upside. So in GDX, again, bullish divergence here that continues to build, that has not been negated. We're not really going down, but we're not going up. We're just waiting for that catalyst. That catalyst could be the Fed. Now the last back test here, again, we had this bearish or bullish falling wedge. We kind of broke out. We haven't really gone anywhere. So the market's waiting to see what comes out of the Fed, and really it's what they do, what they signal next down the road. I've talked about the fact that I don't think the Fed has the opportunity to hike rates too much more. They're going to hike obviously on Wednesday because it's pretty much priced in and the market's expecting it. I don't think they can hike too much more, because if they start hiking too much more, just everything's going to start breaking. We're already seeing, you know, if you go to the TNX, this is a way to look at the 10-year treasury. And I want to talk about longer term stuff. If I go to, let's go to the monthly chart on this one. And you'll notice on the monthly, this is really going all the way back to 1982. Rates have been falling since 82. So that's provided stimulus for housing in the market for the last 40 or so years. But, and each one of these big drops, this is the Fed manipulating the interest rates down artificially through their QE programs. There's COVID. Now, as I zoom in, you can see what's going on. Look at that right there. We're starting to break to the upside of this downward channel that's been in place for 40 years. You start to see rates impulsively breaking higher out of this trend, and a lot of things are going to start breaking in terms of businesses collapsing, pension funds starting to fail, just major problems that have really been reliant on the cheap and easy money and the low interest rates for over 40 years are going to start to break down. And so I don't think the Fed's willing to let that happen, at least not yet. So, you know, things to watch. Now, if I go to the daily or the weekly, you'll notice that we are actually building higher and higher in rates with negative divergence on the weekly, okay? So that tells me that we're probably going to get a sell-off. Bonds are going to get bid while rates fall, and we're going to fall back into this price channel, all right? And from there, we could easily go down to the bottom of the price channel. Right now, if I go back to the monthly chart, bottom of the price channel puts us down around 1.5 on the rates. We're at 3.5 right now on the 10-year, so that would put the 10-year down at 1.5%. The market is happy and dandy, all down there. Everything's no problem. So I don't know. If that happens and we see rates fall, we could get a rally in triple Qs, and you know, we'll watch for that. But the bigger play, I think the better play right now would be gold and gold miners. Gold has been smashed on the anticipation that the Fed is going to be fighting interest rates or raising interest rates and fighting inflation. I think anybody that has, you know, a logical mind knows that they can only go so far without breaking everything, and it's just a matter of when do they make their pivot. So, you know, if they don't make a pivot right now for the next meeting, then we could see rates spike and things really start to, have problems. So it's all going to watch. I don't know which way it's going to go. Maybe we continue to build this divergence. Rates spike. Triple Qs drops down to that low 238 area. That's completely possible. And then the Fed reverses. Okay, if I go down to triple Qs, we do have this target on the daily chart of right down here at 238, all right, 240, somewhere right in there. So we could just plunge right down there and rates spike, and then the Fed reverses course. That's possible. So if that happens, then you're probably going to see gold continue to fall. So as of right now, the triple Qs is kind of set up bullish on the hourly chart. Okay, it looks like there's going to be a rally. Gold is set up bullish. Looks like it's going to rally there. Bonds are set up bearish with negative divergence. Looks like, or bond interest rates. Sorry, the rates are bearish, which means bonds will go up. TLT will move up, basically. And the dollar is set up bearish. That's how the setup is right now. We'll see if that plays out after the catalyst of the Fed this week. Individual trade ideas. Oh, we can look at oil too. So oil, here's oil, kind of stepping in and buying it. I don't know. I think oil is probably just rallying into resistance right here at about 85, 89, and probably going to sell down with the next leg lower. That's what I see. Oil seems to be downtrending, which should help ease up on the inflation pressure, and it continues to check my narrative. It continues to give me, proof that my narrative's right, which is interest rates are going to come down a little bit. The Fed is talking a tough game, but they're only going to be able to hike so much, and they're not going to be able to get interest rates above the rate of inflation. They're just going to get closer to where they are. So a little bit higher interest rates, lower inflation, the Fed will start to ease off, and inflation will continue to run hot, probably for the next decade. So I think the inflation trade will continue to work, over the long-term perspective. But there's always corrections within a bull market. So commodities, things like that, continue to be correcting. If I go to DBA, this is commodities, kind of creating this big. This is the hourly chart. If I go to the daily here, kind of got this flag, and it maybe sets us up for a move down to 1750 on the next leg lower, and that's probably the end of a correction within this commodity bull rally. So I think commodities have started a bull market, a longer term bull market that's probably going to last 10 years, but you have corrections along the way. So I think we rally from down here, 1760 area, and then rally up for our next leg higher. All right, let's look at individual trade ideas. LLY, this one looks like it's continuing to work. So on this one, again, I talked about the last 4 days we were just chopping sideways, going nowhere, but it still looked like we're going to break to the downside. And we are today down about 2%. Now we hit that near-term support that they seem to be trying to hold. Here's an hourly chart, and you'll notice here on LLY that this was support once, it tagged it twice there, and they're holding it there today as well. It will likely hold here until the Fed, but I still see this going lower, and my target right now, back to the daily chart right now, is still down here at about 284.50. The 200 days just above, but I still think we're going to kind of break down below the 200, hit that support, and then maybe bounce back and hold. 284.50 is the support target right now. And the reason why I think it will continue lower, and I've pointed it out, is big negative divergence on the daily chart. All right, big bearish rising wedge pattern, negative divergence. This tells me we're going lower, and sure enough, we broke, we back tested, we're back down at the support. It's just, we're right on the edge basically, and we start to break, it will just continue to signal a downtrend has started, okay? This is our downtrend, and it looks like it's going to continue. So I like that one still looks good. Starbucks was one I talked about. I'm not in love with this one, but here's the thing. We have negative divergence. It still remains. This last divergent high last week looked like they were pumping it, but so far they've already sold almost half of that, and it's not going down, but we're not really going up. So I think we break to the downside. I still like it. We need to take out, really we'll probably break down here and head back down to 83, get a little bounce there, and then most likely continue lower. Okay, so I like that for more downside. At a minimum, I think we break down to about 80 bucks. Okay, from where we're at, that is a drop of about 13% or so. Is probably the downside, with limited upside, especially with this negative divergence in play. First Solar, FSLR, talked about this one. Look, guys, on the daily, you can see they're just kind of popping it. They got a little bit more to go, but this high that if it makes a high, especially today or tomorrow, it's going to be a divergent high right ahead of the Fed. Pretty risky, at least to go long on that one. I like it for downside. Sorry about that, I had a phone call. So on this one, again, we had an uptrend line we were watching on the daily chart. Started to break, not super impulsive. They're doing a little back test, but again, we're popping up, making a new high, slightly new high. It's a divergent high and has a high probability of failing. All right, so I think it will. And at the end of the day, target is really this gap fill, right it down around 78. Now I wouldn't wait for it to get a perfect gap fill. We start to get close, drop, get close, I'll just cover and take profit. All right, this one from where we're at right now is a potential profit if it was to hit the target of about 43%. Now it doesn't look like a lot because I use log scaling, but that's a nice trade. Okay, so we start to get in that area, catch a 30% winner, I'll take it. All right, so I like it. Something that's kind of interesting, I'm going to wrap with this one, is Netflix. So Netflix obviously got sold really hard in the last couple months or whatever. It had two huge gap downs, trapping all kinds of bullish money and just, really bad selling. But recently, obviously I've been talking about this big bullish divergence that had been building here. Okay, so these lows really were divergent lows, all right? All through here, divergent lows. And recently we've started to really kind of create a pretty timid uptrend, but it is an uptrend nevertheless. You can see we're moving higher. Now here's your gap, the most recent gap at 244.88. And we pretty much marched right up in that area. We got rejected on the first tag of it. Looks like we're heading right back up there. There is the potential probably on the Fed or right after the Fed to pop this, enter this gap and run up and hit the 200-day moving average and fill this gap right here. Okay, there is the potential for that. With the bullish divergence in play on the daily chart, and we're basically right up against that resistance line again. Okay, you can see resistance, and we're right there, just about there again. We start popping that and entering that gap, it could be a pretty swift move right to that gap fill. That would be a move, waiting till the gap basically, that would be a move of about 30% or so. So you could see a pretty impulsive move on Netflix after the Fed, I would think, if the chart's going to play out like it's set up. It is kind of a bullish setup. So, okay, I'm going to wrap up here, guys. Check out the stock market technical analysis course. I put that together at request of my subscribers. I was reluctant to do it at first, but I did put it out there. I think there's some value there for you guys. So if you're interested, I'm not giving it away for free, but I'm not charging crazy prices. Link in the description below on that one if you're interested. And then finally, if you want to join the private member group, in there I just give additional trade ideas and some market insight. Feel free to join up on that. There should be a link in the description below on that one, or there should be a join button if you're not on an iPhone. Apple seems to lock that join button out, but you should see that join button next to the basically where the old subscribe button's at if you haven't already subscribed. So subscribe, like, join up on the groups, take the course if interested, and I will catch you on the next one.